This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 8th. Some highlights from today's show. The US economy is now flirting with a recession. OPEC has increased oil supply, and the US trade tariffs are now in focus. Good day, traders. Welcome. Happy Monday. Another week and a lot to get through from a sort of a macro perspective. We've obviously had quite a news-filled weekend. So let's get stuck straight into it. I think before we get, of course, onto topic one and talk a lot about the non-farm payrolls and the implications of what that data print means in terms of the US economy as well as for the Fed. Let's just talk a little bit about some of the market moves as a result of that, because I think what we've got is somewhat of a head scratcher where there's relative calm again. It's this scenario where the markets have shrugged off what at face value is just very bad data. It doesn't matter how you want to look at it, doesn't matter how you want to slice it, doesn't matter what report you want to read and how you want to cover it up in terms of, because of new measurements and the BLS and blah, blah, blah. The reality is that face value, the labor market is softening. It's not just been softening for this print. It's been softening for 4 prints in a row. So we call that a trend. And the trend has been very much to the downside. Now, of course, if we then start to factor in things like revisions, well, we had the first negative print of job creation going all the way back to COVID era. Now, the point is that this is effectively something to be switched on for. It is a change. The trend has been weakening. Now, suddenly, we get some revisions for negative prints. All of this doesn't exactly point towards a hunky-dory situation. Okay. Now, it's important to stress that because that is ultimately what we have from a data perspective. What we have from a market perspective is quite the opposite. Okay, one would expect with the data print that we got on Friday, one would expect the vol to be a lot higher. Now, if we look at the VIX, it's not so much so. It's been squashed again. But if we look a little bit at the internals and we look at the implied vol going forward, well, something interesting is happening, which is markets are now starting to price in a higher level of vol moving forward. Okay, and this is absolutely what you would expect. You would expect a much higher vol environment moving forward. Okay, so we've not seen it at face value. If you look at the stock market, you look at the NASDAQ, the S&P, the Dow, all those sorts of things, you would think, wow, they should have had some really big down days on Friday. And yet, yes, we had the initial sell-off, and then things stabilized. And we finished down 0.4%, 0.3%. It really was a very stable session, which was unexpected at a price action level. Okay, now, there's a number of reasons this could happen, and we'll talk about that. But accompanying that, we would have expected yields, of course, to drop aggressively, and they did. Okay, they did drop quite aggressively, and they've maintained that drop. We also would have expected the dollar to be sold quite aggressively, which to a degree it did, and it did sustain it. So at face value, the market moved in the way it did, but perhaps maybe not as aggressive as we expected. Now, there's reasons for that, and we'll get into that. And of course, this is an ongoing discussion. It's not something we're going to deal with in 15 minutes today. It's something we'll start to unravel over the course of the next couple of days and weeks. But what I want to just put out there is do not discount the non-farms data from Friday. Do not. Okay, it is a significant number. It was a very, very strong signaling. And the Fed, no doubt, is guaranteed to cut in 2 weeks' time. And I expect they are going to cut 50 basis points. Okay, why? Well, it's very simple. Jerome Powell, if you've been watching him for the last 7 years, you will know he's all about insurance and taking out insurance. He's very proactive as a Fed chair. And if we lean on last year, September, we know that the Fed, at first sign of labor weakness, it was a small signaling of labor weakness, they very aggressively acted. Okay, they still think they're restrictive. They still think they've got a long way to get to neutral. They are not going to hang around and cut 25 basis points if they think we've suddenly fallen off a cliff. Okay, so I think the market is not yet of that same view right now. The market is pricing in roughly a 10% chance of a 50 basis point cut. I expect over the course of this week that's going to move closer to 50-50. Okay, now very interestingly, and this was mentioned to me by one of the traders on the floor, if you go look back, of course, we are in blackout period now for the Fed. Okay, so they can't speak. They're not allowed to give their viewpoint. but it doesn't mean they cannot feed something to some of the main publications. Okay, Wall Street Journal, of course, we know Nick Timiraos is known as the Fed Whisperer, and if we go back, of course, back to the era of high inflation in 21, it was Nick Timiraos that ultimately was tipped off that the Fed was going to move a bit more aggressively. Okay, so make sure you're following Nick Timiraos on Twitter. Make sure you've got Wall Street Journal notifications up, because I do suspect we could get something this week which suggests the Fed is quite comfortable with the idea of 50 basis points. Okay, keep an eye on that. It is something that will move the market. It is a very, very high probability outcome for this week. I do expect the markets to reprice. We haven't yet seen that pricing event, and I think that's the key takeaway from the non-farms. Now, like I said, I think there's a few things to pay attention to in terms of the overnight moves, and we're going to start off with this big company at the top there, given it is the world's most valuable company. It ultimately was down 4% week to date. Now, why does that matter? Well, look, Nvidia is the one that put us up here back up to record highs, and Nvidia has been selling off not just last week, but the week before and the week before. Okay, and Nvidia seems to have topped out, whether you want to call it a head and shoulders pattern or whatever you want to call it. The point is, Nvidia was leading to the upside. It's now the week of all the Mag 7, and so I suspect the rest of the Mag 7 is going to follow on this week. Yes, Google was a standout last week, probably one of an outlier. Of course, there was some news flow with regards to that, but if we look, sort of at the main two AI companies, both Microsoft and Nvidia, down on the week. Okay, we ignore Tesla to a large degree, and we look at the likes of Apple and sort of Meta and Amazon. Okay, not stellar weeks, not bad weeks, not stellar weeks, but ultimately just small positive. Okay, so I expect a little bit of that optimism to perhaps be tested this week, and I think if Nvidia does post a down day today, I think the sentiment is going to start to shift a little bit more towards the downside. Okay, like I said, again, there's two things that can happen here. We got to follow Nvidia. Nvidia is going to give us the sort of the heads up, and we also have to follow the implied vol. Those two things are going to tell us what's going on. At face value, price action wise, the equities have not yet rolled over. They're not yet signaled some sort of a bearish topping out pattern. So I do expect this week to be quite revealing, but I would say in the short term, it is very much 50-50 whether we go up, whether we go down in terms of price action. Okay. In terms of the bonds and currencies there, I think it's a little bit cleaner. I think it is a week to be long bonds. I think it is a week to be short of the dollar. I think it is a week to be long of gold. There's a bit more clarity there, but in terms of the equity space, it very much is a 50-50, and I think to a large degree it's going to depend on what Nvidia does and what ultimately volatility does and implied vol going forward. Okay. One thing that is interesting, okay, commodities again. If you go look at the Bloomberg Index or the Bloomberg Commodities Index, another very strong start to a week. We can see, of course, oil up 2%, and we'll talk about that in a moment when we get to OPEC. But we can see just another very strong start for pretty much all the main commodities, from precious metals to energy. Just a really strong start to the week. Okay. In terms of course, nat gas and energy in general, there is obviously some talk around EU sanctioning of companies that are buying oil and energy via or from Russia. So there's perhaps a little bit of that involved as well. But in general, commodities are quite strong at the start of the week. Okay. Now, getting into some of the headline data, you can go read through this yourself. I'm just going to point out a few things. Of course, Trump has told us his top 3 picks now includes Waller, Walsh, and Hassett. Again, we're probably not going to find out much more information about this. But of course, we know Walsh is a true and tried candidate. We know Hassett, of course, is currently under the administration's wing, so he is very much going to be seen as somewhat dovish. And of course, we know Waller's put his hat in the circle to say, look, I don't mind being Fed chair. He's currently there with the Fed. He's currently talking about, or he was talking about pre-non-farms. Should the labor data continue to weaken, he's going to be very much pushing for 50. So you can all but guarantee Waller will be pushing for 50 basis points cuts at this current meeting. But there is Trump's top 3 picks. We also know that Trump is growing ever more frustrated with Putin. No deal yet on Ukraine and Russia. We spoke about this last week. It means that at some point we're going to get an announcement. Okay, at some point what's going to happen is Trump is going to up the ante. It's going to be in the form of perhaps targeted tariffs against anyone that does import oil from Russia, and more than likely going to point at China. Of course, he tried his luck with India. Doesn't seem to have worked the trick. The point is that now it feels like Trump's going to have to get a little bit more aggressive. And so if anything, you got to keep your eyes open because something is coming. Okay, something is coming. It's important to sort of map out those scenarios just to make sure that you're aware of what he can and can't do and what the implications could be for some of the markets. Okay, and then of course Standard Chartered is now also calling for a 50 basis point cut. I think they copied me there basically, but yes, I'm very much of the belief they are going to cut 50, and Jerome Powell's not going to hesitate. He needs the insurance. He's not going to hang around given policy is restrictive. And then just in terms of course, when we could see a little bit of shift in these expectations, we do have CPI out on Thursday with PPI on Wednesday. And I think the sort of the way to think about it, and we'll talk about this later on in the week, but the way to think about it is if inflation and PPI come in line or miss, okay, if it misses, I think the odds of a 50 basis point cut this week will move to around 50-50. If it comes in line, I think we'll steadily see the odds of a 50 basis point increase. Okay, of course, a lot of things can happen between now and then, but I suspect most of the rates movement is going to come Wednesday and Thursday, okay, based on what the data does. If it beats, okay, if inflation beats the upside, well, that's a slightly different sort of set of data to navigate. It will point towards stagflation, but we'll talk about that when we get, of course, to Wednesday. Okay, and then like I said, EU is considering new Russian sanctions, and of course we do have a French Prime Minister facing a vote of no confidence that he is expected to, of course, lose. Do markets care? Not really. Yes, we've seen some widening of spreads between French and German bonds, but it's not really a market-moving event. Do keep an eye on that spread. Okay, should you see that spread blow out, perhaps, and move 15-20 basis points in a couple of hours, yeah, then sure, there'll be some implications for the euro and some of the European equity markets. In general, though, not really a problem for the markets right now. Okay, and then of course we know that the OPEC gave us that increase in supply. Now, what's interesting is the way this was framed is OPEC is increasing supply. They're continuing this idea of bringing back the supply they took off the market a couple of years ago. And ultimately, oil initially sold off, and it's now rallied, and it's currently up 2% on the day. Why? Well, I'll tell you why. If you know OPEC, they are a cartel. And we know that information doesn't exactly stay internal. So this was perhaps leaked to the market a few days in advance, and it explains absolutely why oil dropped from 66 down to $62 a barrel off of nothing. It also absolutely explains why when we received a news flow on Friday that OPEC was going to increase supply, the market initially sold off $0.50 and retraced very aggressively. The point is, it was in the market prior to the weekend. Market participants knew about it. Does that mean it's not important? Absolutely no, it is important. Okay, it means that OPEC's going to continue bringing back supply into the market. We can see since we've of course settled with the whole Israel-Iran attacks, we've seen oil steadily moving out of backwardation, steadily moving towards some form of a contango. Now, right now, this backwardation won't necessarily support the oil, but it will hold the oil from dropping lower aggressively. Okay, I think long-term at a policy stance, if you just take a macro view on this, the fact that they're going to keep bringing back oil at a time when we are perhaps seeing a little bit of excess supply building does suggest ultimately oil prices will remain very much with a sort of overhang resistance. Okay, in other words, rally should be sold into. Oil's not exactly about to rebound, particularly given we're seeing a slowdown in growth around the world. Okay, so oil is a sell-only market. It's not a market you want to be entertaining on the long side. How it sells off, of course, that will depend on how much oil gets brought back. Now, the general line of thinking is that there is a price at which we trade, at which shale oil gets removed. Okay, in other words, shale companies in the US are no longer profitable, so they remove that supply. And there is a general line of thinking that is at the heart of that, and some other things are at the heart of OPEC's policy right now, which is drive the price low enough. They can afford to do it. Obviously, they'll squeeze their own margins, but they'll eventually get some market share back from the shale producers in the US. Okay. Keep an eye on this. I think should we see that move towards zero, which I think is very, very likely in the near term over the course of the next 4 months, we will see that sort of create some sort of downside pressure in oil. But absolutely, do I think we're going to $56 this year? 100%. I think that's the case. Okay. Keep an eye on this level at $62. I think it's an interesting one, not just because it's my blue line, but because you can see we did struggle there in June. We struggled there in August. We've really kind of battled to see a commitment from the short side there. We did also see some not necessarily longs enter the market. I think this was just a little bit of a profit-taking move. Like I said, I think that news was in the market already on Tuesday. So should we get below that $62 later this week? I expect that to be the case. Once we confirm the close below there, I do think we'll start to see that drift a little bit lower. But don't expect a straight line drop. Expect a lot of two-way trade, a lot of consolidation, but the line of direction should be pretty straightforward to the downside. Okay. In terms of then some other things, we do have the French political situation ongoing. You can go and read that for yourself, and as well as some of the implications. We also have, of course, Japan. Ishiba has now kind of stepped aside. The implication of that, I think, the equity markets loved it, and that's only because the general line of thinking is whoever comes in is going to be a little bit more of a spender, and equities love spenders. But I think one thing to take away, the bonds did respond to this. Okay, we can see that the 30-year bonds are about 1.5 basis points from last week's high, and of course last week's high was pretty much the highest made, in the last 20 odd years, or 30 years almost. So keep an eye on yields this year. That's the only thing you need to worry about as a trader, as a macro trader. Just watch what Japanese yields do, because they have got the ability to create a spillover effect into the likes of gilts, to the likes of some of the other bond markets. Okay, right now, a bit of a yawn moment, a bit of a, okay, interesting, but not really a problematic situation, and nothing really actionable for us as traders. Okay, in terms of then, one last thing, tariffs are now coming into focus. It's important to start to understand the order of effect, or the sequence of events. We do have a very important deadline coming on September the 15th, when the Supreme Court will ultimately tell us whether or not they'll hear the case or they'll dismiss it. Okay, if they dismiss it, what they're in essence saying is that we are going to uphold the federal court's decision, and therefore Trump's tariffs are illegal. Okay, now it's very unlikely. I think probability-wise, around 75% chance that the Supreme Court will hear the case. But again, that's the first thing that we will find out on September the 15th, which is, ultimately, are they going to hear the case? If yes, it means then we now go through a sort of a process which takes time. Now, all you really need to understand about this is the dates. I think that matters next week, the 15th. But what's more important ultimately is what comes as a result of this. Well, look, if the Supreme Court does hear the case, okay, what that in essence means is that we're only going to find out the implications of this perhaps at the end of this year, early next year. Okay, so you have to think of yourself as a business in the United States. You're not going to know the implications of tariffs for the next 3, 4, 5 months. We know that the most important selling season for every major US company is, of course, November, December. That's when most of the sales are generated. So if you've got this uncertainty where people are not sure whether or not these tariffs are going to be in place in 6 months' time or not, the reality is you're only going to get uncertainty once the Supreme Court decides to hear this case. Okay? Now, we know fine well from a GDP perspective, from an economic perspective, uncertainty means people are going to delay decision making. You delay decision making, it means we are going to see GDP growth drop. Okay, and that's the implications of this whole situation, is that if the tariffs were in place and everyone agreed the tariffs were in place, well, then businesses can get on with things. They accept that that is now the situation, that is the law, and they can get on with business. The fact that the Supreme Court is now going to hear the case, and this is going to take time, creates uncertainty. Uncertainty means downward revisions to demand and growth. It's as simple as that. That is the formula. That's what we are going to come to understand the next 3-4 months via the data. But what you need to understand is this is not pointing towards a good situation. Now, there's a few things you can go and read through here. This is from the Budget Lab. It's brilliant. It's really, really well done. I've posted this link in the Discord channel. Do go and read through it, and I'll summarize it for you. But what it talks about is the implications of these tariffs. Okay. Now, what you need to understand is the average tariff has moved up to 17.5%. Okay. So straight away, think about it. Things are now 17.5% higher versus 2.5% higher. So you're paying 15% more for imports. Okay. It's ultimately a tax on the consumer. They're paying 15% more. Now, the implications of that is that the US government, yes, they will raise around $2.4 trillion over the next 10 years. Okay, and yes, that is a significant sum of money. The question, of course, the administration tells us that it's the sort of international community of companies that are paying for this. But from Goldman Sachs, they're telling us roughly around 80 to 85% of this is being borne or being paid by the US consumer. Okay. The point is that it's not quite the way the administration makes it out to be. It is very much a tax on the citizens of the United States. And so, yes, the $2 trillion is fantastic for the government, but it's coming from its own people. So if there's a tax on the people, there's less of ultimately demand that are going to come from the people because they're paying that money away to the government. Okay. Now, this is good for the government because it means they're ultimately got an extra additional revenue source. They, from a fiscal stance, they obviously need to raise less in terms of capital, and that means less issuance of debt. So there's that positive angle. But the point is demand destruction is demand destruction, okay? And that's the reality, is that we can see that there's a loss of income per household of $2,300 per household in the United States as a result of these tariffs, okay? The implications in terms of GDP, well, based on this report, they're talking about US real GDP will drop this year by 0.5%, okay? And ultimately, in the long run, the economy will be 0.5% smaller or 0.4% smaller. Okay, that's significant. I mean, the US economy is the biggest economy in the world, and we're talking about losing 0.4% of the GDP as a result of these tariffs. Now, again, it doesn't matter whether you agree with these tariffs, you think they're right, they're wrong. The point is if this report's right, then there is a significant revision that's going to have to take place, not just in the stock market, but in so many markets. Okay, so it's almost like the market's dismissing this. It's almost like the market doesn't understand it. It will understand it at some point, okay? And the markets will become reactionary to this at some point. When is that point? Well, we have to follow price, and that will ultimately dictate when that trade comes. Okay, in terms of the inflation side of things, they're talking about, well, not inflation, first unemployment. They're talking about unemployment to rise by 0.3% this year, and then, of course, by the end of next year, 0.7%. Now, I mean, just take a second and think about that. If we're currently sitting at 4.3, which is what we got on Friday, and they think it's going to be 0.3 higher as a result, I mean, perhaps that takes us up to 4.4, 4.5. And ultimately, if it's going to be 0.6, 0.7 higher from that point, we're talking about an unemployment rate around 5.2, 5.3, 5.4. Okay, we will in effect trigger the SAM rule at that point. We are then thus in a recession. Okay, now, yeah, 5.5% of unemployment's not necessarily guaranteeing a recession, but it would be a significantly high unemployment rate that would prompt, of course, very aggressive rate cuts. Okay. The point is this report does not point to tariffs being net positive. Higher unemployment, higher inflation, lower GDP growth. That is the implications of the tariff situation. Okay. And there you have the summary. You can take a picture. That's pretty cool. And yeah, again, I think it doesn't matter how you want to cut it. Yes, the government gets 2.4 trillion in terms of revenue, but it's coming at an expense, and that is a smaller economy, higher unemployment, higher inflation. Okay. Now, in terms of the non-farms, there is the chart. All I want you to know about this is that purple line is what matters. Okay, it is the trend. It's the 3-month average. The 3-month average is 29,000 jobs created. The Fed has told us they need around 70,000 jobs to keep unemployment from ticking up. Okay, the 3-month average is 29,000. That's all you need to know. Fed Powell is going to want to cut 50 basis points. And like I said, I think as soon as that inflation data print comes out, we'll get that answer. Now there you can see the implied vol. I think this is what I was telling you about. The market does seem to have taken notice. I think that's important. The market is seeing this as, a concern. Not a big concern, not a oh my god concern, but a concern. Okay, now what I expect to happen is I expect this to be a very important week, a very revealing week. Like I said, equities are a little bit difficult to call at this point, but this matters. The market's shifting up the implied vol, which is what you should see. If there's a likelihood of a recession, ultimately implied vol should be a hell of a lot higher than what it is right now. Okay, price action not there yet, but definitely you can see some signs of the market taking a little bit of concern on that number. But there is the VIX. Okay, like I said, the VIX tells us a slightly different story, which is we're not so worried today. We're not so worried right now. And so that's why I said equity is a little bit difficult at this point. If you argued, yes, it's bearish because it's a recession, I wouldn't disagree with that. If you told me, no, it's bullish because AI and everything's fine and the price action is strong, I wouldn't argue with that case either. The point is equities are a difficult call here. Follow the price. Okay. And then, of course, there's NVIDIA chart. We can see we close below that 170. It matters. Just watch NVIDIA. I expect this is going to drift down a little bit low over the course of this week. How low? I don't know. I don't really care. I'm just using NVIDIA as a proxy. If NVIDIA is ultimately weak, we do want to pay attention to that because, like I said, it led to the upside. Equally, it will lead to the downside. Okay, a lot of things covered today, a lot to go through, but I think you're starting to get an idea of the expectations. We've got a few interesting things out this week. Like I said, the major event is Thursday. You're going to have to keep your nose dry until then. You're probably going to see perhaps a little bit of directionless trade, particularly in the equities. Until then, like I said, just to recap, long bonds, short dollar long gold, definitely not short gold, are perhaps some of the key trades for this week, some of the key tradable opportunities. We'll get into those over the course of this week. Thursday, of course, is the major events. We will get the CPI from the US as well as the ECB updating us. So keep an eye later on the week. That's obviously when you want to really put that capital to work. Any questions, post them in the Discord channel. Don't forget to like, subscribe, comment, say wonderful things, share. And as always, good luck out there. Manage the risk. Go make some money.